Way out west, you've been doing research to try and quantify the risk reward of various base versus paid up editions. All right. I touched on it. Hang on, I gotta sneeze. I touched on it in my 70-30 versus 90-10 video. Can I provide more details about the risk of dividends and PUAs? Okay, so when it comes to the different design splits, dividend payout from the insurance company is going to be the highest on base premium. When an insurance company declares their dividend for the year, that's just a gross number. That's kind of like the average number. They don't pay out that same amount to every policy that they own, to every policy that they are contracted with. It varies based on your age, your health rating, how close you are to fulfilling your obligations there, paying that base premiums, if you've done a reduced paid up, right? And how much base premium or how much PUA you're getting. All of that can affect your actual dividend payout. So, the base premium gets the biggest dividend. Just in general, the base premium gets the biggest percentage of dividend. Let's say, as an example, the dividend rate might be 6%. The dividend rate might be 6%, the declared dividend rate. What the base premium on one policy might see might be 6%. The paid up addition portion of that policy would likely get just the guaranteed 4% growth. Okay, it's going to at least get that 4% guarantee. It might get more than that, but you get the 4% guarantee. Okay, so we're just going to assume it gets the 4% guarantee. Now, one might think, why don't I just do base premium then and get that higher dividend? Well, the reason you don't do that is because the underlying cost in the policy is a lot higher. The 4% guarantee on the PUA is going to pay out beginning in the first year. If you only go base premium or you do a higher split or whatever, that 6% may apply to let's do a all base premium policy. So if you put in $100,000 into the policy and it's all base premium, you're not going to have any cash value in the first 2 years. So that dividend payment is not, you're not getting any dividend payment for the first 2 years. There's no cash value for it to accumulate on. You're getting a little bit in the background. You might get a little tiny bit. But for the most part, the dividend then starts to grow after those first 2 years, and it starts to generate cash value. Because you don't just get the dividend on the base premium. You're getting it on the value that's in the policy, the cash value that's in the policy, and the percentage of that that they figure out based on the base premium and the dividends. It's a little bit complicated, as you can tell. So, with a 90-10 design, we end up in that first year with 90% cash value, or close to it, close to 90% cash value. A little tiny bit of that, well, in the first 2 years, none of that's base premium. So our growth in the policy those years is just going to be that 4% guarantee on the base premium. So immediately, our policy is going to be growing in cash value faster than the pure base premium. Because that one's not really getting anything. It's not really getting much anything at all. Down the road, let's go 7 years down the road. Now the base premium is starting to get a little bit of cash value, but remember, it does not break even until like year 15. Sometimes year 20. I mean, it can take a long time for an all-base premium policy to break even. So, it's slowly growing in value. And yes, it's going to get that higher dividend payment, but on a much, much smaller amount. Meanwhile, our 90-10 design is getting 6% on that little tiny amount of base premium and 4% on the big, huge amount of cash value that we've been generating in there. And so it's growing in cash value leaps and bounds ahead of the all base premium policy. Theoretically, 30, 40 years down the road, you can still keep contributing more money into that pure base premium policy than the blended design. Possibly. It depends on the carrier that we're using. And you're going to see a number that's higher under the dividend payout column. But the actual growth in the policy, almost every time throughout the whole life of the policy, is the actual growth is going to be higher in the 90-10 design. That's been my experience when we compare the same carrier with the 90-10 design, 60-40, 70-30, all base premium, any of those designs. If you're comparing carrier to carrier, the one that has the lower base premium ends up with a much higher cash value at the beginning of the policy and all the way throughout it, including a higher death benefit. When might that be different? That might be different if the dividend rate changes drastically in the future. Remember, we're in a very low dividend rate environment right now, which is partly why that higher base premium or that higher blend, the lower blend, it takes it so long to catch up, and it actually never catches up to the other design. Part of that's because those dividend rates are just not high enough. Now, if we go back 20 years and the dividend rates are 8, 9, 10%, if we get back to that environment, you'll probably see those policies perform better. They will end up passing in cash value compared to a 90-10 design. But are we going to get back into that type of dividend rate environment? Who knows? And if we do, when? So are you going to, when you try and decide on your policy, are you going to pay a lot more in commissions to the agents? Because that's one of the biggest effects with the 90-10, 70-30 whole life or all base premium policy, is that 10 in the 90-10 and the 30 in the 70-30. That's the amount that determines the commission to the agent. So in a 90-10 design compared to a 70-30, the agent's going to get 3 times as much commission in that 70-30 design. And in a pure base premium policy, 10 times as much commission. So you've got to decide, do you want to pay a whole lot more in fees? Because that's what that is. That commission comes out as fees in your policy. That's why there's not much cash value growing in the early years. Do you want to pay a lot more fees at the beginning to your agent on the chance that down the road, 10, 20, 30 years down the road, the dividend rates are going to go up high enough that it makes it worthwhile? And you give up that early liquidity in your policy. Now, for me, personally, I'm not going to make that bet. We're in a very low interest rate environment. We've been in this environment for the last 10 years. That's why dividend rates keep coming down. And I expect we're going to be in this low interest rate environment probably for another 10 years. And it may go on longer than that. With the way that our government gets ran, low interest rates is the crutch that we need to keep this economy going. So every time they try and raise the interest rates, the economy crashes. How is that going to change in the future? I don't anticipate it's going to change much in the future, which means I think it's highly likely we stay in a low interest rate environment, which makes it very challenging for insurance companies to pay out very high dividends. So I don't think it's going to change. I would rather go with what we have now and what I anticipate in the near future and lock in much greater liquidity right now and greater potential gains all the way throughout the life of the policy. I mean, we got to trade. It's like trading in the stock market. You trade off what you know and what you can see, right? You don't trade off what might happen 30 years down the road in the future. Now, you can invest for that in the stock market, but hardly anybody just puts all of their money into something that might take 30 years to pay out, and it may not pay out, when you've got the opportunity to put it into something that pays out right away a lot better. So take your pick. I know what side I'm going to be on that choice. Way Out West says, thanks for answering my question and thank you for the level of detail. I've not seen, read, heard it explained that in depth. Happy to help. Happy to help. I also mentioned that dividends pay for the blended riders and that they may not be enough to pay the riders in full. What do you do when that happens? Pay more or allow your policy to be affected? Okay, so what you're referring to, oh yeah, this is one of the risks that I didn't mention earlier. So one of the risks also with the higher blended design, there's some assumptions that get made in there. And some of those assumptions are that we're going to get a certain amount of dividends that's going to buy paid up additions. So that growth in the policy is going to buy paid up additions. Well, if dividend rates come down, you may not get enough paid up additions bought in order to match the illustration and keep it from becoming a mech with how much money you're putting into it. So, is this a big risk? Not really, because the solution to that is you just have to withdraw a little bit of money. So, if you put in $100,000 and the dividend rate drops a little bit, and now that $100,000 doesn't generate enough paid up additions to keep the policy performing as expected to keep it from becoming a mech, in order to fix that, I mean, you might have to pull out a couple $100. Probably at the most a couple $100. It's not going to be like out of this world, you've got a mech and it's a nightmare to fix it. Not the case. The way to fix it is to just withdraw a little bit of what you put in. So if we have a policy design where you can put 100,000 in and you get this really good liquidity at the beginning, and the risk is maybe you only put in 99,500 in order to keep it from becoming a mech down the road, it's not that big of a risk. Not that big of a risk. So that's how your policy is affected if the dividend rate comes down and it doesn't buy quite enough paid up additions. Now, keep in mind, we're in a low dividend rate environment already. There isn't a whole lot of room for it to keep coming down before we run into the guarantees. It depends on which carriers you're using. A lot of carriers are already below the 4%, but the top ones that we like to use are up around 5.65 to 6%. Okay, so there is still some room for those to come down. But like I said, we've already been in this challenging environment. If things turn around even a little bit, they should be able to hold the dividend payments that they're currently at. But even if it comes down a little bit, I don't mind. I mean, you just don't contribute quite as much as we designed. It's not the end of the world. Certainly, you don't have to make it turn into a mech. Those are pretty easy to avoid. And you can't just pay more. That's part of the issue. Most of your carriers will not just allow you to pay more. Some of them might, but some of them just don't allow that type of thing to happen. Okay, they won't let you put more money into a policy without going through additional underwriting. So that's something to watch out for. Okay, you can't just, if they do allow it, you could just pay more and that would fix it as well. If you just were able to buy some more paid up additions, that would probably fix it as well. But worst case scenario, you just take a little bit of money out and you're good.
Hope you found value in today's video. If you'd like to find out more about IUL and whole life, check out these videos right over here, and we'll see you next time.
Now go maximize your cash flow.